One financial analyst who spent 2 decades studying the markets agreed to a rare on-camera appearance to issue his biggest warning ever. He says the biggest market bubble in history is popping. So you can do nothing or take this one simple step to prepare now. This past winter, he began issuing a big warning about inflation and a looming market disaster. His timing was nearly perfect. But he promises you there's still time to act, to protect yourself, and potentially see some of the biggest gains of your life in the coming years in the right time-tested assets. Ones that tend to skyrocket in times of inflation, like hard assets, energy, and gold. He's put together a 5-stock model portfolio, a way to not just beat inflation, but benefit from it. This dead simple one-step investment approach could show you a series of triple-digit gains or higher starting right now. You could set yourself up in minutes and likely forget about inflation, rising prices, or the worst effects of a market crash for years to come. The critical thing is that you act now. Do your future self a huge favor and get the facts free of charge. To watch our full interview for free, simply go to inflationprotection2022.com. Again, that's inflationprotection2022.com to watch our full interview. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show here on Stansberry Research. Back with me today is Alf Peccatiello. He is the publisher of the Macro Compass newsletter. He's also a former head of a $20 billion portfolio. Alf, always good to see you. Happy August. Welcome back.
Hey, Daniela. Hi, we just discussed about today being a public holiday in Italy, but this is no Italy anymore. So let's get the interview done.
I was going to say we're filming this August 15th, and it's basically blasphemy for 2 Italians to be working. But that's how dedicated we are, Alf, because we have a lot of important topics to talk on and inform our audience about. So let's start with your recent report, which I read with great interest. That basically says, what soft landing? That was the Federal Reserve dreaming about. And I think it ties in perfectly with this news headline coming out now of the National Association of Home Builders saying the U.S. is in a housing recession as sentiment turns negative. This is something you've been talking about for a long time. So now that the housing market is slowing, what's next? What does this tell us of what is to come?
Well, what's come, it's probably even worse housing market conditions going forward. And now the US, just to give an indication, Daniela, of how bad the situation is this is the 8th monthly straight decline in the National Association of Home Builders Index, housing index. 8 straight monthly decline. The last time this happened is in 2007. So we're looking at outright level of these indices actually being pretty low already, but also the fact that the decline is so prolonged month after month, it doesn't really bode well. And we talked about it in the past. When you spike up interest rates and mortgage rates, while the real purchasing power of people, salaries adjusted for inflation, haven't gone up, they've actually gone down. How can people sustain these prices if they don't have a higher real salary, but they're facing much higher mortgage costs? They simply can't, right?
So talk to us about the perception, right? Because obviously what we're hearing from mainstream media is, oh, okay, the latest numbers show there's a handle on inflation here. We have the Inflation Reduction Act, which, I was just telling my other guest has very little to do with inflation, but more of a climate bill. So there are obviously these optics that inflation is being curtailed. What's the real deal here, Alf? What's going on?
So what's happening, Daniela, is that finally we got a slowdown in the momentum of inflation, right? And that's important because if month over month inflation keeps going up, at some point we're going to end up at 20-30% inflation. Nobody hopes for that, right? So it is at some point even natural that month on month inflation actually slows down. But when you look at the number itself and the composition of this slowdown, you got to wonder, where is it coming from? What did actually slow down? And most of the contribution in the slowdown of month-on-month inflation came from energy, commodities, energy, etc., that took quite a hit. So gasoline prices are down, oil prices are down, other commodity prices are down, and that's good. But the problem is that these are very cyclical part of the economy, while the stickiest part of the inflation baskets, that they really didn't do that well. They kept going up on a month-on-month basis. The stickiest one is rent of shelter. Rent of shelter happens to be in the core services prices basket. And these prices are the ones that go down the last in the economic cycle, are the ones where once you cement expectations that these price pressures continue to go up, it's very difficult to make them go down. I put a chart as well that shows the momentum of rent inflation in the US. That's not decelerating. That's still pretty high, also historically speaking. And unless that goes down, the core services basket of inflation accounts for more than 40% of inflation overall. So if you're not able to slow that one down, you won't be able to see that sustained slowdown in inflation that the Federal Reserve needs to be able to accommodate conditions.
So Alf, what's the way to slow that down? Will they just keep raising rates, or what tools do you use to fight this?
Well, the Fed has one tool. Imagine if I had a big hammer right here in my back, I would just pull it up to show what is the tool the Fed has. It's one big hammer. It's a very blunt instrument, which is a combination of raising interest rates and reducing the balance sheet. So Daniela, if you ask them, what is your nuance? Can you slow down this but not slow down that? They can't do that. They can just raise interest rates across the board, make borrowing for you, I, and our listener more expensive so that we pare back. We're like, sorry, but I can't afford this anymore. Effectively, they have to do enough damage to the real economy until demand is hit hard in a way that inflation can slow down as well. They don't have any other option.
But going back to perception, of course, always, do you agree that there's a perception that we've hit peak uncertainty? And I point to investors piling into high yield bonds here as a sign of that. Would you agree?
Well, the latest rally that we have seen, Daniela, was spurred by two things. The first was that people heard Powell say something that he really didn't want to say. During the press conference, everybody understood that Powell had pivoted. Everybody felt that the Federal Reserve was done. They were happy with it. How can they be happy with inflation at 8.5%? How can they be happy with unemployment rate so low and wage pressures building up? They can't be happy. And the other thing I hear is that, yeah, Alf, but inflation month-on-month basis is slowing down. Yes, okay. It will slow down to 3 to 4%, and that makes the Fed happy. No, the Fed won't be happy with 3.5 to 4% inflation. Their mandate is 2%, and if they let go 3.5 to 4%, Daniela, what happens is that we tend to expect that inflation will remain that high. So our consumption habits, our investment habits, they tend to change, and they don't want that, right? So this perception that you're talking about actually led to this rally. But I feel that this perception actually has to wane down when the economic reality kicks in again, and when people realize that the economy is slowing down, and unless inflation really takes a nosedive, a very hard nosedive, the Federal Reserve has their hands tied.
What's your feeling of how this plays out? I mean, I've had a lot of experts on saying that the Fed will reverse course and start, printing money again. But from what I'm hearing from you, I don't think that's the case. Do you think that they're just going to keep marching higher with interest rates?
Yes, they will. They will, because you think about these policymakers, Daniela. I mean, when I run the money for the bank, the $20 billion book, I had the luxury to go and talk to these guys sometimes in conferences and in meetings, right? What they always told me, policymakers in general, so prime ministers, central bankers, is that what they like is a controlled setup, a situation in which expectations are cemented. Right now, they're not cemented. People have seen inflation to 5, 6, 7, 8%. If you're a central banker, your mandate is price stability. Price stability means that not only inflation needs to be below 2% or around 2%, but also the expectations need to be centered around that. So you need to achieve your outcome to keep it there for a while, and then you can maybe think about what's happening on the growth side, what's happening in the labor market, what's happening in the stock market, not before.
Okay, so this goes back to a point you made back in May where you were saying the Fed, it's inflation, meaning this is top of mind for them. But at what cost, Alf? I mean, if we keep getting higher interest rates, what about the stock market? What about the risk of recession? And that's a whole other debate, whether we're in it or if it's coming. Yeah. What about those concerns?
So the short answer to this question is given by the Federal Reserve themselves. They have a summary of economic projections where they tell you what they think the labor market, unemployment rate, and GDP will be. Daniela, right? Have you ever heard or seen a policymaker, the Federal Reserve, or the government tell you that a recession is coming? I've never seen them. Never. Ever, right? So you have to take their estimates with a pinch of salt. They're generally very optimistic. They themselves are telling us that unemployment rate will jack up by 0.5 percentage point. So from 3.5 to 4.5 over the next 2 years. If they're saying that, it's very likely that they're being very optimistic. So they're assuming that they will have to generate some damage to the real economy. I expect unemployment rate to end up much higher than 4.5% in this cycle. But it goes to show that even if they themselves, which are always very optimistic about growth, in the end it's their job to do so, right? If they are telling you the economy is going to slow down and unemployment rate is going to pick up, then you normally have to double at least these expectations to really understand what will be going on. They know there's going to be side effects, and they can't get around that.
So, that said, you've given us your thesis. What are sectors that you like from an investor standpoint of how you would protect your wealth?
Yeah. So in June, at the end of June, but I think still right now it's a pretty good opportunity for long-term investors, is to start buying some good quality bonds, 10-year, 30-year, long-end bonds. And you might say, why? I mean, if inflation is going to remain relatively sticky, why would you want to buy long-term bonds? Now, my answer to this question is the following. If inflation remains sticky, then central banks are going to be even more aggressive, Daniela. They're going to take short-term interest rates, they're going to jack them up until they actually win this battle. Somehow, they're going to manage to choke the economy down to slow down inflation. Choking the economy down will be reflected in long-end bond yields, because a 10-year or a 30-year bond as a yield tend to reflect long-term expectation for growth and inflation. And if you have a Federal Reserve or an ECB that is so committed to choke the economy right now, to even send it into a recession if necessary to slow inflation, this will be reflected in long-end bond yields. And I think if you buy now these treasuries at 3%, for example, in terms of yield, you actually have a protection for when the market goes down, stocks and other risk assets, but also you are locking in 3% that reflects long-term growth and inflation that I think will be lower because the Fed does so much damage now that over the next 5 to 10 years, this will have to be reflected in long-term bond yields.
How important is it for you to be in cash now?
Pretty much. So the allocation I have in my long-term strategic portfolio, it has let's say, a time horizon of, let's say, a year roughly, or even more than a year. So it's for a long-term, medium to long-term investor. The allocation is pretty high in dollar cash, has been the case since the beginning of the year. And it's also pretty low in what I call the high-risk sentiment, cyclical asset classes. I'm talking about crypto, I'm talking about Russell, I'm talking about the equity market in general, especially the most cyclical part, the lower quality, more aggressive, more risk sentiment side. The allocation is very, very low as it can be. I have some equity allocation to the more defensive side, consumer staples, defensives, utilities, healthcare, sectors that will not do extremely well, but if you want to have some allocation for a long-term equity, I would prefer that. And then I bought some bonds now to protect against that downside. So it's a lot of cash, equity allocation very defensive and very small, and bonds. That's what I have right now.
So on that note, I'm curious to get your forecast on the US dollar and euro.
Yeah, so on a tactical term, I am pretty bearish on euro dollar. I think the euro can easily breach parity again. And the reason is pretty simple. So if you look ahead, Europe is facing a pretty dire situation where real incomes have been squeezed even harder than in the US. Why? Because the economic pickup that we have seen in Europe and also the inflation story has been much more driven by the energy squeeze than by a real strong labor market. For that reason, wages haven't been able to pick up that much in Europe, but inflation, because of the energy squeeze, has picked up, which has made people have much less purchasing power than before. Now, lower real incomes means a weaker economic growth in Europe than it is in the US, and the energy situation, looking at this winter, is really looking bad, Daniela. The electricity prices in Germany and France are looking at 10 to 15 times higher than the last 10-year average.
Yeah,
I mean, we're talking about 1,000% higher. I have many business owners that I know, but also you can see that in the data already, that some of these industries in France, in Germany, in Italy, they are not viable, Daniela, if the input costs are so high, if gas is so expensive, if heating is expensive, if electricity is so expensive. You have to see lower levels of economic growth because the production just can't be there. It's not economical anymore to keep some of these industries open. And I think if you look at the Russia and Putin strategy, his willingness will probably be to squeeze these as much as he can to get something out. As winter approaches, he will not be more lenient. He will probably be squeezing Europe even further, which makes me pretty bearish on the euro.
Do you feel, and I have to agree with you, and I think that's a brilliant summary of what will happen in Europe. Do you feel that countries like Germany, Italy, France, whatever, do they have other solutions in place in terms of where they're going to get their gas from?
I wish, but I don't see any short term. I see some long-term potential solutions, and I think Europe is doing a decent job in trying to plan for the next 10 years. But Daniela, the next 10 years is the next 10 years. We need to face winter right now over the next 3 to 6 months. We have literally a physics problem in Europe because our gas and electricity sources are coming from exactly those physical locations that are right now basically in a war, and therefore we are effectively denying supply, and they are denying the supply of these resources in size. There is a physics problem short term, and I don't see an easy way to fix that.
Yeah, I am greatly concerned for what will happen this winter. Just to wrap things up here, Alf, I mean, you've kind of painted a very dire picture here. Just final thoughts for investors watching.
So I would say this is the time to be defensive rather than offensive. There are cycles in investing, Daniela, and there are cycles in the economy too. And I think as an investor, you want to preserve your purchasing power. You don't want your wealth to be destroyed, right? And so right now, I think the best thing to do, and I've been saying that since the beginning of the year actually, is to be defensive as much as you can. If you can be tactical on certain opportunities, okay, but for a long-term investor, there is a time to be defensive, a time to be offensive. This is not the time to be adventurous in your asset allocation.
I have to ask you, why as part of your defense strategy, and I know we've spoken this in the past, but why do you not see gold as part of that portfolio?
Yeah, so this is a very good question, Daniela. And the problem with gold is that gold is priced in dollars or in euros. And now what the central banks are trying to do to slow inflation down is to make the real return of owning these euros and dollars more attractive. So that instead of investing and spending and doing stuff, by simply keeping these euro and dollars, you have a higher return adjusted for inflation than you used to have in the past. So the price change of gold against which is priced, remember, in this euro and dollar, tends to be affected by real interest rates, by the real return you can generate by simply owning these fiat currencies. And despite long-term, I think gold is a pretty good asset to have in the portfolio, and I do have it in the very long-term portfolio. Short-term, if central banks are trying to make these real yields high, at least higher than they were, to fight inflation, this is not a productive environment, cyclically speaking, to own gold yet. There will be a time.
Okay. And you're going to let me know when that is. You're going to be the first.
Well,
I'm going to be the first phone call.
You invite me here on Stansberry, I'll be happy to do that.
You're always welcome. You know that, Alf. And I need to end with this because I encourage everyone to follow your Twitter. You're besides being knowledgeable, you're great fun, and you are a foodie. You take your food seriously. But I have to know one question before I let you go, because I want to know what drives Alf crazier: spaghetti cut with a knife and fork, carbonara made with cream, or cappuccino after 3 p.m. What would it be?
Wow, Daniela, wow. Oh my God.
This is my toughest question.
I would say the worst of the three is all of them. None of them are acceptable. I am sorry. Even worse than this, there is only pineapple on pizza, but none of this is acceptable.
I forgot that one. Genius. There you go. Don't upset Alf, folks. Alf, always a pleasure. Thank you.
It's a pleasure to be here on Stansberry.
And thank you so much for watching this edition of the Daniela Cambone Show on Stansberry Research. We'll have more incredible guests like Alf coming your way, so be sure to stay tuned and sign up at danielacambone.com so you don't miss a beat. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.